The easiest way to make money back paying for college? Getting it back in the form of a tax credit. This isn't just any tax credit we're talking about. We're talking about the American Opportunity Tax Credit. America! But for whatever reason, the American Opportunity Tax Credit is so unknown by so many middle-class families. But it can provide up to $2,500 a year back to the family per child because it's a tax credit, not a tax deduction. You see, credits come back dollar for dollar match come tax time. If you qualify, you got to take advantage of it. But how do you qualify? Let's cover the 7 ways in which you got to make sure that you are qualified to get this credit back to you. What's going on, everybody? Danny Sinowitz, the college dude here. Be sure to subscribe to this channel for more great content when it comes to planning for college and paying back student loans. 1, kids got to be in college. And it can't just be any old college. It's got to be an accredited institution. The kid has to be pursuing a professional degree of some sort. He cannot just be taking classes for fun.
Bro fun, sir.
The other key is that the kid needs to be a dependent on the parent's tax return. If the kid isn't showing up on the tax return, you can't claim the credit. Number 2, the kid has to be enrolled at least half time.
50%. Over 50%.
You can't just be taking one course. You've got to be enrolled as the school defines it as a half-time student. If you're half-time, kid's eligible, you're eligible for the credit, you should be looking to take advantage of it. Number 3, the expenses actually have to be qualified expenses. So in other words, you got to look at the IRS definition. I'll give you the quick skinny here. You can find it all in IRS publication 970, but qualified expenses include tuition, fees, books, and equipment. You cannot be utilizing this for room and board or for transportation costs. Number 4, the other key, you can't make too much money. I know, making too much money, that's a problem, right? In this case, it actually is. If your modified adjusted gross income is over $180,000 and you're married filing jointly, you're not eligible for this.
But we're broke.
If your modified adjusted gross income is below $160,000, guess what? You are eligible for it. If you're anywhere in between the $160,000 to the $180,000, you are eligible for a phased out credit. So the key is you need to make sure that you keep modified adjusted gross income low. If you do, you're eligible for the credit. Divide those numbers in half and that'll give you what you need for single filers, for head of household, and for qualifying widow or widowers. Married filing separately is not eligible. Number 5, no felony drug convictions. If the student has a felony drug conviction on his record by year end, not eligible for the credit. What you could do is look at a backup credit, which is the lifetime learning credit. It's something that could provide some benefit to you, but it's not going to be at near the same amount that the American Opportunity Tax Credit will be. Moral of the story?
Don't do drugs.
Number 6, you want to make sure that you're filing this correctly. In order to file this correctly, you need 2 tax forms. Number 1, you're going to get from the school, the 1098-T. The 1098-T is going to tell you how much you actually paid towards tuition and some of the other qualified expenses in that tax year. The other form that you're going to need is the Form 8863. That Form 8863, you attach to your 1040, voila. You can get the credit if you qualify for some of the other criteria. But make sure that you're filing these 2 forms. If you don't know what you're doing, reach out to a professional.
You're a professional. I'm a professional.
They know exactly what they're doing and they can help you out. The 7th thing you got to keep in mind, you only get 4 years in which you can claim this. You can't claim this for more than 4 years per dependent. Again, at that point, after 4 years, you can claim the lifetime learning credit if you need extra years. However, the 4 years of undergrad is really when you're going to be able to take advantage of this, and you absolutely should be taking advantage of this. But remember, this is on a per child basis. So if you have multiple children in school and one student phases out and no longer qualifies, don't discount the fact that you can use this for multiple students. Last bonus tip that you got to make sure of. Do not be using pre-tax money to help pay for this, or previously known as tax-favored money. What is tax-favored money?
What is that?
Tax-favored money, for example, would be money from a 529 plan that you're using to pay for tuition. On that 529 plan, you got tax deferral and you can take it out tax-free if you're taking it out for tuition. So what does the IRS say? Can't do that. No double dipping.
You double dip the chip.
When all is said and done, you got to make sure you're planning this out correctly. It's not hard. Just make sure that you qualify. Check your tax return, modified adjusted gross income, line 11, to see if you're in that $160,000 range. If you're over that amount and you can shorten that amount, there are ways to lower your modified adjusted gross income. If you're interested in that, subscribe to my channel to learn more about some of the ways in which you can actually plan for college and save for college. If you got questions on this, be sure to reach out to your tax professional, your tax attorney, or your financial planner. The information we provide here today is completely general in nature and educational in nature. It's not meant to be taken as specific advice. If you do have further questions though, check out my calendar link, schedule a call, and I'll see you in the next video. Until next time.